Now, before we get into Europe, just kind of round it out, we've had some fun commentary so far from the Powell. So a funny question was, is it time to start thinking about raising rates? And Powell says, not yet. And his comment is looking for actual progress instead of forecasted progress. And I mean, maybe we're just looking at completely different data sets. But, well, we're going to cross that bridge as we come to it. As, Powell's is saying that inflation still remains below 2%. But again, maybe I'm the only one experiencing inflation in my neck of the woods. So now we can turn over to Europe and what are some of the European components that we're seeing, and what is some of the activity that is going to come into the market now that we've had Lagarde speak. We've had the different backdrops of what Lagarde has said, support that's going to come into the system in general. And I just wanted to pull up, some of the key components that have come out since then, which isn't too crazy. So I just wanted to kick off this because we've seen more uprisings. We've seen more pressure across just activity in general. When you think about the poverty line, some of those pressures. So NATO spending has increased. So 11 nations met the guidelines of dedicating 2% of economic output to defense. It's also helped because GDP has collapsed. So it makes it a little bit easier to meet that number. But this is going to be something to watch as we start to get some of the recovery and some of those pressures. With the UK has talked about pivoting more to Asia, specifically utilizing some U.S. assets to house some troops in order to keep things cost down. Because when you look at the U.S. position in general, China has more assets than the U.S. But when you look at the U.S. and her allies, you can see that we have more equipment than China. So it is a different shift in terms of what I think President Biden is going to do going forward, of trying to incentivize allies to become a bigger part of sort of this push against the pivot to Asia and looking at what is happening with China in general. So this is just one of those key components. Now, when we look at activity through Q1 and into Q2, Europe stays in lockdown mode. So this is who has national lockdowns, national curfew, local curfews. So the local lockdowns are coming under additional pressure, especially with France seeing an increase in COVID cases, Germany, Italy, something similar. We expect to see a bit more stringency over the next week or so as they try to combat this, now that there's a delay in some of the vaccine capacity, which is also going to shift consumer behavior, because when consumers are seeing this increase in cases, they're going to mitigate spending, they're going to do less, they're going to travel less, they're going to try to stay indoors more to try to avoid excess of exposure, which is again going to be a headwind to GDP capacity. So then when we look at Europe struggles for that full rebound, when you look at the kind of the pre-crisis trend and where they're projected to be, it's going to be very difficult to really close that gap given the amount of stimulus that they put into the market and what stimulus is available, because again, they were struggling before COVID. And this is what we keep talking about when we keep going back to the end of 2018 into 2019 into early 2020. Things were starting to struggle, and this is why it's going to be tough to continue to see this recovery as the ECB balance sheet has moved to an all-time new high. They're continuing to ramp up as these conditions worsen within the country overall. So then when we look at what is happening on just homebound or people that are furloughed that are still being paid. And so when we look at Italy, use of furloughs remained high in the wake of the financial crisis and shot up during the coronavirus. So now you have 4.33 billion hours that are furloughed, but they're not the only ones. So let's just take this piece by piece. As Europe reels from the coronavirus pandemic, governments in Germany, France, and the UK are paying millions of furloughed workers to stay home. By paying workers' salaries, they hope employers will keep them until the public health care and economic crisis pass and then reactivate their businesses quickly. The policies also reflect a desire in Europe to avoid the social cost of large-scale layoffs, which, as in what we're going to talk about in the article, when you have people laid off, when you have people that get disenfranchised, they're more likely to riot. They're more likely to take to the streets to change their position. So that if you're paying them to stay home, the hope is that they will be happy with getting their check and they won't be apt to get disenfranchised, struggle, and be better on the other side. Italy has been doing that for decades, turning what was supposed to be a short-term program to save jobs into a permanent fixture. Now, an especially weak economy and a glacial rollout of vaccines in the EU means millions of workers will remain furloughed well into 2021. And as we know, Germany, France, and Italy are all looking to increase their overall activity and their overall stimulus to try to generate more activity, which is going to be capped with just as we've seen in general, when we look at just the pressure from COVID. So then industrial production in January 2021. So just looking at, it was the industrial production, it was expected to be negative 1.9%, came in at 0.1. So here you can see just how slim that move is. And now with additional pressure coming into the market, this is going to see additional roll through. Now, February will be a little bit better, but then March is going to see some struggle. But it's going to depend on February because things started to soften in the back half of Feb and then just continued to get worse through March. So how quickly we get that industrial recovery as we continue to talk about exports, imports, because those are data points that remain problematic, especially when we start looking at, labor costs in Germany going up, CPI going up, wholesale prices going up, but the expectations, survey expectations in Germany, they were expected to be at 74%. They came in at 76.6%. So a slight improvement, but again, we're getting this problem when we look at CPI and just what is some of the capacity that is coming into the system overall, which is why when we look at the rebound in Euro area, hours worked has stalled. So this comes to more people furloughed. If you're furloughed, well, how long, maybe you're making less than you have in the past. Maybe you're just getting a percentage, so you're not going to spend as much. So that is just putting additional pressure. So the German business surveys, employment barometers continue to trend lower, which is why even though some of the data points have gotten better, as you have costs going up, your salaries remaining flat or a percentage of what it was, so your ability to spend and generate GDP growth is going to be hindered, which is, again, looking at some of the issues that's happening in the UK with the British exit impact. The exports to the EU are through a floor. So now we've fixed up some of the issues on the fishing side. That's going to start to normalize a bit. But so far, non-EU nations are fine. It's just how are they going to get back some of their largest trade partners and a large part of their economy, given two sides. One, you have the regulatory hurdles now, but you also have falling demand from just a rise in COVID cases. So how are you going to see this problem alleviate itself, which is why Europe's problem becomes the UK problem, as there's just less buyers of your stuff, which again is just going to pull down those GDP estimates. So then when we look at the pandemic purchases, the bond buying remained muted ahead of ECB's pledge to step up the pace. Since then, we've seen that they've talked about increasing it as we head into Q2. So first, the Governing Council will continue to conduct net asset purchases under the Pandemic Emergency Purchase Program, PEP, with a total envelope of 1.85 trillion until at least the end of March 2020, and in any case, until it judges that the coronavirus phase is over. Based on joint assessment of financial conditions and the inflation outlook, the Governing Council expects purchases under PEP over the next quarter to be conducted at a significantly higher pace than during the first months of the year. So as Lagarde said, as the ECB said, we're going to get an acceleration of purchases, which is going to move this further back to where we were in November and December. But what does that mean? Well, German wholesale prices year over year went up. So here the latest is at 2.3%. So we're seeing these prices continuing to go up. We see the stimulus going up. And again, the CPI continues to go up. Germany is an exporting nation. So if they're prices are going up, that means that their export prices are going to go up, which is going to increase the price for their importers. As diesel prices go up, the cost of shipping it is going to go up. You're starting to see how this compounds on itself, and we're still at the early stages. So, given Powell can say whatever he wants, these are those leading indicators that are very important, which is why M3 is skyrocketing as we see it going into the end of 2020 and as we go through 2021. So the euro area HICP on all items is going in one direction, which is going to be supported by PPI. Wholesale prices, all of these things are going to pull a lot of this CPI up, and especially when you have M3 going to the moon, and it's only going to go up with more PEPP action and more stimulus that's expected to come out of not only the rest of Europe, but more importantly, Italy after Draghi's recent comments. Now, another key capacity when we look at passenger cars in Europe, because everybody likes to focus on, essentially green energy in a time of crisis. But when we look at the alternative, you can see that there is an increase in purchases of EVs due to incentives, tax incentives, other types of adoption, and just the quality of the car has gotten better as everything from Volkswagen on down has introduced something that is a very viable option versus some of the shortcomings of Tesla in general. But when you look at the alternatives, how much are these tax cuts or tax incentives going to cost? Because when we start looking at lithium production by country, lithium production continues to go up. But as supply has gone up, the problem is demand continues to outstrip supply, which not to say that you can't continue to ratchet up, but as China limits some of their exports, there's going to be a problem because we're going to fall into a shortfall unless we start to get some additional supply. Now, there is nothing better to snap people into reality, especially in commodities, because what is the running joke? How do you cure high prices in commodities? High prices. How do you cure low prices in commodities? Low prices. Why? Because at high prices, everybody's going to try to create a mine. At low prices, nobody's going to try to create a mine. And that's where you start to see some of this balancing act. So as the prices continue to increase, the supply side will start to fix itself. And then on the other side, though, China is continuing to withhold or starting to hoard or build more stockpiles of rare earths, lithium and nickel and other key commodities, which is driving the price up of a lot of these Chinese. It's driving the price up in China. So they're ratcheting down, not exporting much, which is then going to ratchet up price in globally. Again, kind of looking at how do these tax incentives, are we going to see price increases from car manufacturers because they're just going to be more expensive to build the batteries, and then or are they going to try to increase tax subsidies? And that tax subsidy. So even if you get an increase in the price of the car or the price of the battery, then the tax subsidy will have to increase to offset that. These are things that we have to look at as we go forward, especially as we dip further into Asia and some of the problems that are arising there. And because in the next segment, we're going to look at Asia in general with a bigger focus, obviously, on China, but also going through some of the other key data points as some pressure continues to roll out, especially on that economic data front. Following the end of the Chinese Congress, China is meeting the U.S. and Alaska, and we have a lot of new things coming out and some big data sets and data points that have come from China. And we want to look at that because the base effect is now in place. So we want to kind of average out some of that base effect and look at some of the real numbers and what that works out to an annualized level.